To have you back with us today for another quarterly market review. This go round, we have Tom O'Shea with Innovator Capital Management with us. We're very excited. Tom, thank you for being here today. Good. Well, I know you've got a lot of great information for us, of course, as a kind of a recap to 2025, but specifically what's been going on in the market for the past few months and Q4. So we're really excited to hear about the last half of this year, last quarter of this year, and what maybe you guys have on the docket or in store for next year, and thoughts on potentially what investors should be taking into consideration as they wrap up their year and look at 2026. Tom, just for everybody's background, he's been with an innovator since 2022. He's been a director of research and investment strategy. He helped found the Portfolio Solutions group that does a lot of investment portfolios, multi-asset portfolios tailored strictly to investors' retirement goals at the end of the day, or general investing goals at the end of the day. They have about $400 million in those models that they're utilizing at this point. And really, him and his team do a terrific job of not only providing a lot of thought leadership around the investments as a whole and providing that to advisors as well as to the individuals at the end of the day, but they also help to provide a lot of strategy behind the innovator funds that they utilize on a daily basis. So we're really excited for the partnership that we built with them over the years, and we're really happy that he could share, some of his Wednesday afternoon with us today to make sure that you guys get a little bit of information, some good information about what's been going on in the markets and some outlooks and things to be considering at this point in time. So, Tom, with that, I'm happy to turn it over to you, and you take it from there.
All right, really appreciate the thorough introduction, Will, and everybody, thank you for having me. For those of you that might be maybe a little bit less familiar with Innovator, I'd like to give a quick rundown of who we are, and we're the defined outcome creators and pioneers. If you look at this timeline at the bottom of the slide, we filed for the first buffer ETF in 2017, had the first one launched in 2018, and just from a credibility standpoint. If any of you know, our co-founders are the same gentlemen who started PowerShares back in the early 2000s. They were really known for the smart beta ETFs, and they were purchased by Invesco, which is one of the fourth largest ETF providers at the time. So they went into retirement for a little bit, and they were being pitched annuities and structured notes, and they really liked the ideas of these payoff profiles. But they thought, there's a lot of inefficiency here. These aren't exactly tax friendly. There's, liquidity issues with these certain products. And they thought, hey, what did we do back in the early 2000s that was so successful? We made these strategies in the liquid tax-friendly ETF wrapper. So after launching that first buffer ETF in 2018, that timeline kind of progressed in terms of innovation. We added more buffer ETFs to various reference assets. So the first one was on the S&P 500. Now we have a good lineup of NASDAQ 100, emerging markets, EFA, even bonds, and small cap equities as well. So that innovation continued throughout. We have some accelerated ETFs that are non-leveraged, and we launched the first 100% buffer back in July of 2023. And now we recently launched the first dual direction ETF. So when we think about our product lineup, we want to make sure we're giving financial advisors and investors alike all the potential tools in their toolkit to ratchet up or down the risk as needed. And maybe you've heard some of the news, but our firm is actually being acquired by Goldman Sachs to add another level of credibility there. To give you an idea of defined outcome or buffer space, I think this is a helpful slide to show that in our inception, where we were and how quickly we've escalated in terms of assets and ETFs. And whether you hear from Goldman or BlackRock, they expect this universe of defined outcome derivatives-based ETFs to continue to accelerate through the next 10 years. To give you an idea of this payoff profile, I think this does a really good picture of highlighting why somebody might be interested in a strategy like this. And these are point-to-point strategies. A couple terminology that you might need to know is for these particular strategies, there's a reference asset. In this particular example, the S&P 500 is the reference asset. you have your targeted downside protection or your buffer level, and your predefined outcome period, as well as your upside cap. So going through this scenario analysis using one of our most popular strategies in the 15% buffer on the S&P 500 over a 1-year period. In the event that the S&P 500 declines by 20% at the end of that outcome period, that 15% buffer wipes out the first 15% of losses, and you'd be down about 5% gross of fees. In the event that the S&P 500 declines 10%, you'd be down 0 because that buffer wipes it out entirely. Small upside, think maybe a 7% return environment, you're capturing everything. In a very positive environment like the last couple of years we have, you're actually capped out. I believe the cap's around 13-ish% right now. So just wanted to make sure everyone understands what I think about in terms of products when I'm constructing portfolios. This is really the base here. Some people have questions about how they're trading intra-period. This is an example of a down market where at the beginning of September of 2021 through the end of August 2022, the market started up, which you see in the light blue line. And due to the time value of money in the options package that create these particular ETFs, it lags on the upside. And on the downside, where the market's down almost 20%, you're seeing a similar lag where the particular strategy is only down just under 10%. And once the strategy is pricing in the probability of finishing in that buffer level, you see it trade up to that negative 77 basis points, which is just the expense ratio. In a positive environment, it's a similar thing where you're lagging on the upside, but as the S&P 500 finishes above that cap, you are finishing at that cap level. Now that you're a little familiar with Innovator, what kind of strategies we offer, let's talk about Q4, what happened, and what does it mean for the various asset classes. So I think this timeline is pretty helpful in outlining the major market moving events. Depending on the type of financial advisor you are or what you're thinking about, maybe there's some other events you have in mind that we can talk about. But right away at the beginning of Q4, we had the government shutdown start, and we had a lot of questions from financial advisors. Tom, what does this mean for the S&P 500? Is this going to weigh on us? And I've done this research, and I've seen that going back to the 1970s, the first 6 of 7 government shutdowns coincided with negative returning markets. But after that, the subsequent shutdowns really hadn't interrupted the markets much. And the S&P 500 was generally positive most of those environments. And funny enough, the longest shutdown prior to this most recent one in 2018 and 2019 actually had a 10% positive return. So we joke, maybe we just need to turn the government off at all times and see how high the markets can get. But the second event that came through was some renewed tensions with the US and China. We saw that sell-off at that point too on the timeline. And this is just something that was happening all year, right? And this really spoke to me in a way that you could have your portfolio, you could have confidence in one certain outlook or the other, but there's a lot that us as market participants don't have control of, and that is government policy. So we had Liberation Day sell-off at the beginning of the year, and these tariff tensions are going to go back and forth. We'll see what happens through the rest of the year. Maybe the Supreme Court will rule them illegal, and that'll be a tailwind for a Santa Claus rally. That's something that investors are going to be very attuned to. Looking at the third event that I have marked on this timeline, we have Meta and Oracle boost AI data centers with NVIDIA networking switches. And this is a theme we've seen throughout the year. There's been a lot of strategic alliances, different partnerships, mergers, acquisitions, et cetera. And the market has rewarded all these companies because you think about the top 10 companies of any decade in the S&P 500, and if you're not pivoting or evolving with the market, these are falling off. So these companies are doing anything they can from a spending or partnership point to stay in line and stay top global leaders in the tech community. This is just kind of an interesting event. I wouldn't say really necessarily a market moving event, but we have Michael Burry, the guy that predicted the global financial crisis, shutting down his hedge fund. He was worried about the circular financing deals between some of these different companies, little worried about maybe some of the debt that wasn't being on the balance sheet, some of the tricky accounting that's going on. And I believe through the rest of Q4 and really through the rest of this AI boom / if it becomes a bubble, this is going to be top of mind for investors. At what point is the spending not going to be rewarded? At what point is this debt going to be an anchor on the balance sheet of these tech companies? Moving on, we had the second rate cut in a row from the Federal Reserve. And then we had the longest shutdown in the US ending at 43 days. And the market was up 2%. Again, I don't really think that had anything to do with the shutdown, but I think it's interesting to note that doesn't really affect the markets, even though their economists were saying that it was costing us about $15 billion per week, which is obviously not great. Again, we have some more AI news with Microsoft forming a strategic alliance there with Anthropic and NVIDIA. And finally, we have some more Fed rate cuts. So we have the S&P 500 up a little bit so far. And I think with all the earnings momentum that we've experienced, I think there's a chance that we do get a Santa Claus rally despite some of the tech concerns that we're seeing in the market today. Moving on, this is what happened from an asset class standpoint the first 3 months of the year. And I know this is a Q4 review, but I think it's helpful to give context to what potential patterns are changing as we review what's happened from an asset class standpoint in Q4 on the next slide. So I think one piece of surprising performance was the ex-US equities outperforming the US. So through the first 3 months, double-digit returns from really all global regions, which is exciting. Kind of can't go wrong. But we saw one trend with the dollar having the worst first half performance in a long time. And our research has shown that during strong or weak dollar environments, that doesn't really impact US equities from a US investor standpoint, but there is a huge spread that you see in weak dollar environments for ex-US equities, where there's typically outperformance versus strong US dollar environments. Kind of scrolling down through these different bars, you look at that blue bar from a commodity standpoint, and I think that solid performance really speaks to the inflation narrative. While from a year-over-year standpoint, we're around 3%, it's much lower than 2022, for example. But I think the consumer price levels just being elevated, some investors potentially worried about maybe the tariffs, making things worse, the deficit spending. I think that's something that people are thinking about. The debt to GDP ratio is at 125%. My whole career, people are saying, hey, when is the debt going to matter? When is the deficit going to matter? And I think we're starting to really get into that period. Really the star of the entire year, gold. Some people may be looking at this and say, Tom, what about silver? It's actually higher than gold right now, and that's kind of a high beta gold play in my view. But historically, gold has performed inversely with real yields. As those real yields decline, investors feel more comfortable with gold. But I think at this different environment with high debt levels, the high deficit, gold is being looked at as more of a safe haven and a better risk to reward type of asset class than you would see from bonds historically. Bitcoin, I'm not going to pretend to be an expert here, but if we look forward to Q4, that's been by far the worst asset class. So I wrote a white paper on Bitcoin and its ability to improve risk-adjusted returns in the portfolio. I think this is a perfect example about how you have to right size your allocation based on your risk tolerance. Happy to distribute that if anyone's interested. But looking at this performance versus the first 9 months of the year, you're seeing some trends that are continuing, right? So ex-US equities are continuing to perform well, and I think that trend could be, going forward as well in 2026 and through the rest of the quarter as dollar weakness becomes something that is consistently thought about. Commodities is doing the second best compared to next to gold, and I think that goes on with the inflation narrative a little bit. And finally, we have gold, right? I think this is going to be an asset class that's considered for a long time. You think about what's happened from interest rates over the past 30 plus years. We're in a descending channel where bonds were in a bull market, and I don't think that's the backdrop going forward. So I think this will be a great diversifier for portfolios for the future. Again, not a crypto expert by any means, but there was a large liquidation from one of the longtime holders, and I think they're starting to take gains. Who knows what happens with that asset class? Maybe most of the people on this call don't care, but lately an interesting trend is that some of the drawdowns in Bitcoin have been leading what's happening with the NASDAQ 100. Again, those aren't correlated super highly, but it has been a trend that has been happening recently. Moving on, all-time high momentum continues. This is something that I follow very closely, especially working at Innovator ETFs. A lot of the people that we work with are nervous about entering the market at all-time highs. Tom, what if I time this wrong? I get into the equity market and we see a global financial crisis or a tech bubble burst where the market goes down over 50%. How will I look a client in the eye? And the fact of the matter is, this is behavioral biases coming into fruition, right? If you're worried about buying at all-time highs, you could really miss out on achieving goals that your clients have, because research has shown that when all-time highs occur, they come in clusters. So if you look back at previous bull markets from 1989 to the year 2000, we had a new all-time high about every 9 trading days on average. If you look at the global financial crisis recovery, it took a while to again hit a new all-time high. But in 2013, when we hit an all-new time high, through 2022, we reached 346 new all-time highs, or a new all-time high once every 8 trading days. This current bull market, which started at the end of 2022, is seeing a similar pattern where we're seeing bunches of new all-time highs about 1 every 8 to 9 trading days. So I think it's very important to understand where we are from a market standpoint and say, hey, markets are still pretty near all-time highs. Let's take advantage of that and make sure that we have our clients allocated to a level that matches their risk tolerance. Maybe we got a little over allocated to certain risk assets. You now have the time to lock that in. I think one interesting trend that I will point out in this chart, you see, for example, gold has had 48 new all-time highs, the highest of all these asset classes, which should surprise nobody based on its year-to-date return. However, the first 3 quarters of the year, as demarked by the green bar, we had 38, and then we had 10 new ones in Q4. So it looks like we're having a consistent amount from a quarterly basis, but what really stands out is the right-hand side of the chart, where small cap equities have really struggled for quite some time in this higher interest rate environment. You think about monetary policy and its effects on the economy, on companies. A lot of these companies in the small cap world have floating rate debt. They're more sensitive to high rate environments, which could weigh on their balance sheets, weigh on their income statements, and only had 1 new all-time high through the first 3 quarters of the year. Some of those long and variable lags to the monetary policy, I believe, are starting to kick in, and you're seeing 8 new all-time highs from the Russell 2000. And it wasn't on that last chart, but it's up, I want to say, about 3.2%. So leading at the S&P 500 at this point. You look at what earning estimates have coming in, it's pretty common for them to fall throughout the quarter, but since the beginning of this quarter, 2026 estimates for small cap equities measured by the Russell 2000 are expected to increase by 3.2%. Moving on, we have S&P 500 valuations are elevated. So this is no surprise to anybody. This is, if you have a Bloomberg terminal, you read the Wall Street Journal, any really financial publication, people are saying, hey, we're reaching bubble territory for these valuations. And I'm not quite as concerned at these valuation levels. I'll give some evidence to why that is, but from a historical context, forward PEs are in the 93rd percentile right now over the last 10 years. Small caps, which we just talked about, are only in the 57th percentile, which is potentially more favorable. You look outside the US with MSCI World, ex-US, and emerging markets, those are in the mid 80s, so those might be more favorable from a valuations perspective. You think about market concentration, that goes along with high levels of valuations, and what we're seeing is at the start of the 4th quarter, market concentration has the top 10 S&P 500 stocks making up over 40% of the index. You look at, from a performance standpoint, some numbers that worry some investors. NVIDIA alone, if you start at the beginning of this bear market at the end of 2022, the S&P 500 is up 20% more compared to the S&P 500 x NVIDIA. So that's some of the concentration people are worried about. Hey, if somebody comes out with a better chip, or maybe we're spending too much and the earnings picture sours going forward, maybe that 20% will go in the other direction. From a valuation standpoint, though, NVIDIA, just recently checked on the Bloomberg terminal, has a PE of 24.4 on a forward perspective. Cisco was the top stock in the S&P 500 during the dot-com bubble. That was at 150 during the peak. So I think we have a long way to go before people need to really start worrying about being over allocated to equities. Some other historical perspective for you, Mag 7 names have a forward PE of 34.5, which is much lower than the 47.3 experienced at the peak in 2021. And when you think about the four horsemen, Cisco, Microsoft, Dell, and Intel, back during the tech bubble, that was at 80x during the peak. So, there are concerns, there's always market risks, but I think those aren't flashing huge warning signals to me, at least from a forward PE perspective. Some other metrics that people are looking at include price to sales on a trailing basis. That's hit an all-time high. Margin debt in brokerage accounts, how much leverage people are using has gone over $1 billion recently. Some people follow the Warren Buffett indicator. That's flashing warning signals. But I still think these companies of today are a lot different than the top companies back during the tech bubble, because you think about Google, for example, they have YouTube, they have their cloud business, they have search. You think about Microsoft, similarly, they have cloud business, they have LinkedIn, they have the Microsoft suite. All these companies aren't just doing one business, they have other business units within them to really diversify. And if some of this does go sour from a CapEx perspective, yeah, I think they might have some severe drawdowns, but I don't think it will be quite as bad as the tech bubble, personally. Looking on, we talked about this a little bit, and we have different inflation metrics. We have headline CPI, core CPI, and the Fed's core PCE, which they're targeting. You see all those levels are elevated above that Fed target at 2%. The Fed's in quite a tricky spot here because they have the dual mandate of maximizing employment, and they have to also try and hit that 2% inflation target. What's challenging is Goldman Sachs, and I'll talk about this later, has estimated that 15 to 20% of job losses are due to AI workforce automation. I don't care if the Fed puts interest rates at zero permanently, whatever it does to its balance sheet, that's not going to force companies to hire people. From an inflation perspective, they could similarly hike interest rates really high, but that's not going to be able to lower rents exactly. So they have some pretty blunt tools, and as we mentioned previously in this presentation, the monetary policy tools have long and variable lags, often taking 18 months to 2 years for them really to take effect. So we talked about this. We had the Federal Reserve cutting 3 consecutive times in a row. But if you look at how the yield curve has changed from the beginning of the fourth quarter to where we are as of last Friday, you're seeing the long end of the curve go higher. And many of you know this, the Fed has control over the short end of the curve. You're seeing that huge drop off there, but that long end of the curve is really pricing out economic growth, inflation, and just risk at those tenors of various treasury instruments. So with those rates going higher, what that tells me is that there is risk that investors are seeing from the debt perspective, from the interest rates. And, I think that bonds aren't going to be a great payoff over the next, 12 to 24 months. That's really my Q4 recap. I figure since we're towards the end of the year, I know we have a lot of time left, but I want to talk a little bit about what happened in Q4 and what that means for our 2026 outlook. I'll keep an eye on any questions as we go throughout the time period. So our 2026 outlook was titled Bull Market Tested because we believe that with the valuation stretch, as we mentioned, CapEx going on, and just our historical analysis, year 4 is often where bull markets are tested. We're a historically aware but forward-looking type firm. I think it's very important to understand what has happened historically to maybe make some realistic assumptions of what could happen or what could absolutely not happen in the future. And what we've seen is that 8 of 14 prior bull markets reach year 4. In this particular chart, we're only showing 5 just to be more visually pleasing, frankly. And the light green line, which is our current bull market, which is up about 90% since the end of 2022, which began right before ChatGPT's launch, it was looking like it had similar analogs to the global financial crisis or even the bull market of the 1980s. I think what's important to point out is even in all these bull markets, you see fits and starts along the way. Focus on the dark green line, for example, and there's a lot of drop-offs in that global financial crisis recovery window. And I think with where valuations are and investors questioning, will there really be productivity gains from AI? Or are we just going to have everyone lose their jobs and have to rely on the government for assistance? I think those fits and starts are going to be a trend that continues into year 4. This table here really highlights all those 14 that we mentioned, and I think some common themes really pop out, at least to me when I evaluated these. We've had bull markets going from as short as 1 year to as long as 11 years, but 3.9 years on median is what we expect historically. What we see is, from a performance perspective, the early years and the late years of the bull market are the best from a performance standpoint. Specifically in order, the first year is usually the best, the last year's the next best, and then the second year. And then what pops out next to me is some of the negative years. We don't really see negative years unless the bull market ends like in 1947 or after 2022, but you're seeing some negative returns during these bull markets. It's very possible. So for example, in 1949, in the fourth year of the bull market, it was actually down 2%, which is surprising to people. I think that this turbulence, and that's something you need to worry about from a historical perspective, because when you look at the composition of returns from the S&P 500, what you see historically is that valuations are usually the driver, that expanding PE multiple, as investors are no longer pricing in all the tightening cycle, for example, weighing on investment returns. You're seeing a lot of people excited about ChatGPT and the productivity at the beginning in year 1 and year 2. Through the first 3 years, over 80% of the S&P 500's rise has been due to expanding valuations. But if earnings aren't going to continue to grow, that's going to be an issue and weigh on the bear market. So if you look at the historic bar chart on the right-hand side of the chart, that's showing that a majority of those returns of the last 3 bull markets for which we have valuation data, you need that to come from the earnings. From a calendar year 2026 perspective, consensus estimates are looking at about 14.5% as of last Friday. The second theme that we have is mega cap flywheel powering US equity market. You think about post-ChatGPT release, and you're really seeing those bars from all these top companies rising. I mentioned this before, all these top companies, they're familiar with what happens if you don't pivot. And what happens is you're no longer a top company in the S&P 500. You can't be leading from a technology perspective, from an earnings perspective. So we think that these companies are going to do what they can from an investing standpoint, from mergers, acquisitions, alliances, etc. And Bloomberg is estimating that there's going to be $1.8 trillion in revenue generated by 2032 and contribute 16% of global GDP. So I think even if those estimates are in the ballpark, I think there's going to be a ROI on these investments. Again, we're very historically aware but forward-looking firm in terms of our forecasts, and we looked at prior boom and bust periods, and one commonality found is that equity prices peak before the infrastructure build out. In this particular example, way back when in the 1800s and early 1900s, you're seeing railroad stocks peak before the railroad build out, measured by miles of railroad in 3 distinct periods, and then towards the end as well. If you look at a more recent example, we have the tech bubble. You're looking at the NASDAQ 100 on the bottom, light blue line, and that's peaking before the fixed investment in information and processing equipment and software. What gives me confidence in the levels of spending? You look at what happens from an adoption standpoint. That green line is just overall AI adoption from August 2024 through August 2025. That's approaching about 55%. And when you think about commercial releases of AI, the PC and internet, we're at 55% for AI. That's much better than the PC at about 20% and the internet at 30%. I know anecdotally at work, I use AI all the time. I have a data science and coding background that really helps me in my investment and portfolio construction work. And I feel like it helps me do the job of, without even exaggerating, probably 5 to 10 people. I think even if you don't have that data science and coding background, you found a lot of reasons just using something as simple as generative AI chatbots. So I think we're really just scratching the surface. I think about, my YouTube TV prescription or subscription, and they keep raising it every 9 months. And I'm like, well, how am I going to watch the Chicago Bears go to the Super Bowl if I don't keep paying this? I feel the same way towards generative AI. I think I would pay much more than double. And I think that competition may hold these prices down, but I think all these companies could charge a lot more and gain some revenue here. Let's avoid talking about the bears anymore, but we got a base case here. We talk about a bull case, and then we do have a bear case as well. But I think what's important in these 2026 outlooks is, you could look at back in time innovators, and I think we've done a pretty good job. But if you span the market looking at JP Morgan, Oppenheimer, Northern Trust, et cetera, you're going to see a wide range of outcomes. And I think the process is really important to come up with your expectations for the S&P 500. But what's really important is portfolio construction and be able to capture a wide range of outcomes. So we have a price target of about 7,600 or a 12% return. If you kind of focus your attention to the right-hand side of that table with the change, a majority of that is being attributed to the earnings per share growth, as we mentioned. From just a broad theme standpoint, AI-related revenue and productivity gains will combine well with a dovish Fed, and that will lead to earnings just below consensus levels, and in turn lead to a little bit of decreasing from valuations. Next, we have a bull case. And in my view, the bull case is probably the least likely of the three narratives that we're looking at. I think a lot of things would have to go right in order for this bull case to come to fruition. But in our view, I think there will be some broadening out of AI uses and use cases among those non-tech names. But I think what will be challenging, as I mentioned, there will be a lot of layoffs due to this AI automation in the workforce. So there might be some momentum. Maybe there's huge productivity gains that we're not seeing right now, ways to really increase earnings that are just not in the purview right now that lead to really escalated valuation expansion as well as earnings growth. But you think back to that historical analysis of all the bull markets, we did mention that the last year of the bull market is often one of the highest performing. That could be a situation there as well, where maybe this is the last year of the bull market and you're seeing a huge return there. So obviously a lot of different outcomes are possible, but I think it's important to understand all the potential outcomes. Moving on to the bear case, we see technology competition intensifies. You think at the beginning of this year, DeepSeek, they released a really cheap AI model, and there was a bit of a tantrum from a tech perspective. Maybe there's cheaper chips or better AI models, and then people see that the spending on CapEx appears unnecessary to result in strong ROI. Additionally, maybe these tech-related layoffs start to weigh on consumer spending, and maybe we enter a recession. In this case, valuations are going to decrease meaningfully, small EPS growth translating to a 19% loss in the S&P 500. I think this is a very powerful illustration here. This takes us back to the 15% buffer illustration at the beginning of the presentation, highlighting all of our cases. So assuming you invested at the beginning of the year in the ticker PJAN, which is our 15% buffer from the beginning to the end of the year, if the market does go down 19%, you will only be losing 4% in this strategy. If the base case occurs, you'll likely capture all of that, assuming that that cap at the beginning of the year is around the same levels as our November series. And then finally, at the right-hand side, you'll capture a large majority of that upside. But if this bull market really ramps up, there's going to be some upside that you will not participate in. Our last and final theme for 2026 is a unique balance act, jobs versus inflation. And I touched on this briefly. I think it's really going to be a tightrope walking as this AI workforce automation occurs. You think about what's happened from a GDP growth standpoint, and if AI investment wasn't part of it, we would really already be in a recession right now. So that AI investment is really taking away from other areas of the economy. But we think it'll be similar to this year where there's a low hiring, low firing environment where these AI workforce automation layoffs aren't going to affect us in the current year or the next year. Maybe beyond is when we need to start worrying about something like that. Moving on, this is, I think, very important to note. A survey of the top issues as we're heading into midterms next year. Cost of living is one of the highest on there. And this goes into how tricky it is for the Fed. A lot of people are potentially worried about Fed independence as Trump is interviewing potential candidates for next year. If the potential candidate is maybe a little too dovish, that could reignite inflation and cause some problems. When you reignite inflation, think back to what happens in 2022. You have highly correlated assets, and you're really working hard to dig out of a potential double-digit hole. So looking ahead, Innovator's particular view is we expect 2 rate cuts into next year. We think even if we have an operative in there that is very dovish, we think it'll be very tricky to get the entire Federal Reserve Board on the same page in terms of being completely dovish. But we do think there's going to be 2 cuts next year. From a 10-year yield standpoint, we think that the economic growth outside of the AI is going to bring us down a channel, but still remain relatively elevated in the 3.5 to 4.25 channel. But moving on, I think it's important to understand what particular strategies investors can think of given our 2026 themes and how the rest of Q4 can play out. And one of our exciting tickers I want to talk about is DDFD. This is one of our dual directional strategies. So if you look at the bullets here, this gives you S&P 500 exposure in the event of upside markets where the market goes up 9.5%. You will capture all of that. If it goes up 15%, you're only going to capture that 9.59%. It has a 15% inverse cap. What does that mean? That means if the market goes down 15% over the next 1-year outcome period, you will be 15% positive for the market. What happens if you're down 20%? That 15% inverse cap becomes a buffer, so you'll be down 5%. So why would somebody consider a dual directional ETF? And I think just given the market environment, there's a lot of uncertainty with where the S&P 500 can go. If you look at our base bull and bear case, there's a wide range of outcomes. And I think it's important to think that if you use this 15% dual directional strategy, it aims to make money in 95% of markets. If you look in history, going back, the market is above negative 15%, 95% of the time. In only negative markets, you would lead to a positive return in 75% of markets. So a lot of people wonder, hey, Tom, where should I put this exactly in my portfolio? And before we dive too deep into the other themes, I would say I highly recommend reaching out to me and my portfolio solutions group so we can optimize your portfolio based on these tickers or other ones you're interested in. But there's a lot of use cases for this. Some people see this as a potential bond alternative, wherein if the market goes down, like we said, that 15%, you're able to have positive returns. You think back to 2022, as we mentioned, interest rates were going higher, inflation was high, bonds and stocks were down double digits. So this gives you a structured level of 15% protection to either have a positive return or outperform a negative return with that buffer, which becomes a buffer at those deeper levels. Our next really exciting strategy that I want to talk about is QFloor. This gives you NASDAQ 100 exposure. And a lot of people might think about that right now and say, hey, Tom, during the tech bubble, the NASDAQ 100 was down over 80%. I think that's maybe a little too risky for us. One thing to think about, though, is that during the 1990s, if you invested $1 million in the NASDAQ 100, by the time it got to 1999, that would have $11.6 million. So the amount of wealth creation available in the NASDAQ 100 is undeniable. What's tricky is timing it, and that's, I would say impossible to time it on the way in and time it on the way out, because if you waited a few years later, that 11.6 million would have dropped to 2.1 million. So what is the answer to that? I believe QFloor is a great strategy because it targets a 70% participation rate over longer periods, and it gives you a level of protection through a 10% laddered floor. So a lot of our buffer strategies that most people are thinking about say, okay, Tom, if the NASDAQ 100 drops 15%, I'll be protected for the first 15%. In this particular strategy, it's different. That first 10 to 15-ish percent is vulnerable because that floor is laddered, but what we're protecting is that tail risk, so you're not going to lose 80% of your NASDAQ 100 exposure in this strategy. So how do we do it? We invest in a basket of the NASDAQ 100 securities, and we use an actively managed call selling strategy to fund that tail risk protection. So this particular strategy is a great way to initiate a position, especially right now when we're still near all-time highs. And if this boom continues for the next couple of years, you're not worried about an 80% drop-off because you have that tail risk protection in place. Vault is the next strategy we're going to discuss, and this is a 20% quarterly buffer on the S&P 500. This has $2 billion in assets and is our highest asset ETF in our entire 160 fund lineup. And Vault, we came up with that ticker name because we wanted people to think of it as a bond alternative. That 20% buffer is so strong that if you go back to 1950, there are only 4 periods in which that 20% buffer would have been breached on a quarterly basis, the worst being 1974, the third quarter, when the S&P 500 dropped 25%, which would have meant if this strategy were around, you would have only lost 5%. We really see this as a great way to diversify out your fixed income sleeve and reduce interest rate risk. So if you look at 2022 as a case study, you see there was 3 straight consecutive negative quarters. First quarter was down about 5%. You wipe that loss out with a 20% buffer. Second quarter, we were down about 16%. Again, we had a fresh 20% buffer to wipe that out. Third quarter, another negative 5% situation, completely wiped out. Started to recover at the beginning of this bull market. And what happened was Vault was capped out at 3.2%. And you had a positive return of the year wherein the S&P 500 was down 18% and fixed income by Bloomberg Aggregate Bond Index was down negative 13%. So this is a great way to put, especially in taxable accounts, because it's in an ETF tax-friendly wrapper. When you hold it over a year, you're controlling the tax outcome and paying a more favorable capital gains tax rate as opposed to the ordinary income on investment grade bonds. From a simplicity standpoint, a lot of the advisors we work with simply take 50% of their bond sleeve and are putting this in. So if you're looking for the risk management, reducing interest rate risk, you don't need the income exactly. This is the perfect strategy for that portion of the portfolio. Finally, we have ZDEC, which is a 100% S&P 500 buffer. It has a 6.85% cap, and there are a couple of use cases for this particular strategy. These 100% buffers are very helpful for investors that have time horizon goals. One example that I used recently is, maybe you have a kid that's going to college and you've had that next nest egg saved up and you don't want to risk losing it all in the S&P 500. Say they're going to school the next year, you throw it in this ZDEC and you could capture 6.85% more. But if the market does tank anywhere from 0 to negative 100%, you're going to only be out the expense ratio. Another spot in the portfolio this is being looked at is kind of a cash boost or a cash plus sleeve. Again, it has the more favorable tax treatment like Vault compared to money market accounts. But when you see inflation being stuck at 3%, you look at after-tax returns, having some diversification within 100% S&P 500 buffer is a great way to put your clients in a better position. That is concluding my presentation here. I'm not sure, Will, if we have any questions that are popping in, but happy to stick around.
Perfect. Thank you, Tom. Yeah, it's a wonder why they call you guys innovator ETFs, right? There's a lot of really cool stuff that you guys are doing, and there are other companies out there that are doing the things like the dual direction or the floors or the cap with significant buffers. But you guys have done such a terrific job with this, and it is something that where we can go back out to clients on a regular basis, and instead of, as you were talking about earlier, just doing a quick reallocation of stocks to bonds or cash, or specific types of asset classes in the equity markets or the bond markets. These are some pretty cool products that are out there in the market that weren't available 5 years ago, 10 years ago, definitely not 15 years ago, that allow folks to see a lot of that upside potential in the market with the downside protection in certain cases. And it's really great that that you guys have developed such a great suite around this. And of course, we're looking at the outlook of the market moving forward, but also what's been happening over the past 3 months or even 12 months, and figuring out, hey, is this a good time for us to sit down and kind of reevaluate the risk metrics behind a portfolio with clients? And these things come into play. These things come into the conversations on a regular basis. So thank you for all the great information, not only on what you guys are doing to help advisors help their clients and help the clients specifically, but thank you again for the opportunity to really dive into what's been going on in the market. Some of this goes over folks' heads. That's okay. Hopefully, just ingrains a question in their brain that prompts them to reach out to their advisors and just ask the right questions and make sure that we're focusing on their long-term goals and any short-term adjustments, that we need to be able to hit those long-term goals. So, Tom,
Yeah.
great info. Thank you.
Absolutely. Yeah. As I mentioned in the beginning, everything we're releasing is just to help the end investor be able to reach their investment goals. So happy to impart any wisdom on anybody. And like I said, if you're interested in having a portfolio evaluated, feel free to reach out.
Of course. Thank you. Well, I appreciate everybody watching today. Thank you, Tom, for all the great information. Thank you for the opportunity to partner with you on an ongoing basis, and of course the information that you shared today. So once again, have a wonderful Wednesday afternoon. I appreciate the time you spent with us, and we'll keep you posted on any questions that come in after the session today, and see if there's anything we can do to continue to serve our clients a little bit better.
Excellent. Happy holidays, everybody. Thanks.
Merry Christmas. Take care.